I'm Motley Fool Canada Senior Analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing Royal Bank of Canada's Q4 2024 earnings release. My guest today is Motley Fool Canada Chief Investment Officer Iain Butler. Iain, thanks for joining me.
Great to be here, Nick, on a blustery, snowy day here in this corner of Canada.
Yeah, winter has arrived, that's for sure. But hey, sunny days for RBC. Shares trading at all-time highs after the company reported its sixth straight earnings beat. Iain, what stood out to you from RBC's earnings release?
Yeah, and Royal Bank is the biggest company in Canada by market capitalization, and I think safe to say recognized as the king when it comes to Canadian banking. Maybe there was an argument to be made a year or so ago that TD was right there with them, but that hasn't played out very well. But our question, what we're here to do is figure out if this is a good investment at current prices. So when it comes to bank earnings reports, you can spend hours, days, even pouring through the numbers. These are vast organizations, and company data and metrics are endless. Thing is, investing for me anyway, it's not a game of precision. So to keep it simple, tend to consider just a handful of markers. So we can think about bank profitability. It's measured by a metric known as return on equity. Bank growth is measured by year-over-year change in book value. Bank solvency as measured by the Tier 1 capital ratio. Loan development as measured by provision for credit losses. And bank valuation, perhaps most importantly. And that can be measured by the price to book ratio. And then to evaluate each, they need to be compared to either the specific bank's history or the current state of the bank's peers. So you look back over the course of time, how they measure up relative to where, say, Royal was 10 years ago, or how the current slate of Canadian banks are performing. So again, we're not here to provide an end-to-end analysis. We've got 3 minutes left, and we're just going to jump right in and focus on two of those metrics, profitability as measured by return on equity and the price to book ratio, so valuation as the other. Um, so RBC just reported for fiscal 2024 a return on equity of 13.3%. Its 10-year average was 15.4%. So currently the bank is a little less profitable than it has been over the past decade. Its price to book ratio currently is 2.2 times. Its 10-year average is 1.95 times. So the bank is a little bit more expensive than it has been over the past decade. And then just to sort of cement that picture, we can throw in one more quick and dirty valuation metric, and we can look at Royal's current dividend yield, which is 3.22%, and its 10-year average is 3.96%. So again, that indicates that Royal is a little bit more expensive than it has been over the past decade. So we've got a little less profitable than over the past 10 years and a little more expensive. And when we're evaluating companies to invest in, that combination doesn't tend to be where opportunity lives. In this case, if a company is a little less profitable, to make it attractive, it would need to be cheap relative to history, not more expensive. So based on this relationship, I don't think Royal is jumping off the page per se as an attractive buy opportunity right now.
Yeah, certainly executing well based on where the stock is trading. But what are you paying for that growth? Maybe a little bit more than you would have historically. When you look forward to RBC's performance as the company enters 2025, what are you looking for the company to deliver for you to potentially change that answer to whether it's a company to invest in right now?
For sure. So sticking with those metrics, it's all we have to do, I think, again, just to get a sense of where things are. RBC management has a medium-term ROE target of 16%, and that's not far from the company's 10-year average, which again is 15.4%, as mentioned. So to make this an intriguing investment, if we're talking about a more or less 10-year average ROE target, we should be looking to pay no more than the 10-year average price to book value of 1.95 times. So if the bank were to trade at 1.9 times current book value, it'd be trading around $160 a share, and which is about 10.5% lower than the current price. So I think what we're watching for is how this relationship evolves over the year or 2 or 3 years ahead, how ROE and the price to book multiple plays out. And let's see if the bank can move north of 15% on the ROE, and ideally that multiple contracts a bit, then we might be talking about an interesting situation.
Yeah, we'll continue to follow it. Certainly a company for Canadian investors to stay on top of one way or another, the largest company in Canada, as you mentioned earlier. Iain, thanks again for joining me for this edition of the 5 Minute Major. We'll see everybody next time.
Awesome. Thanks, Nick.